Two. Test, and we're here. Okay. Good morning, everyone.
Morning.
It's 10:01, so we can go ahead and call the September 9th, 2021 meeting to order. Item number 2 on our agenda this morning is a presentation from Morgan Stanley Prime Property Fund. Jason, you want to?
Sure. Just a brief comment. So just continuing with just getting updates from your managers, which we haven't done for a while just because we've been remote. No issues, but we invited Claiborne Johnson and Morgan Stanley Prime Property Fund in. They are your core real estate manager. You have a target of 10% to core real estate. You're a little bit underweight. You may recall back in, it's probably been the first quarter of this year, we made an additional subscription of $14 million to the fund. That hasn't been called yet. There is a queue to get in. It's expected that your money will be called this month. And so just FYI for you all. With that, I'll just turn it over to Claiborne and let him give you an update on the fund.
All right.
If you keep me honest on the clock, too. Okay, good morning.
Morning.
First time doing this in a mask. I'd be remiss not to open by saying that I enjoyed so much the Women's College Softball World Series. I'm a James Madison University graduate and foundation member, and they had a real experience here in Oklahoma. So for all the fans, that was a great thing for the state. So we're here this morning to give you a brief update on the Morgan Stanley Prime Property Fund. As many of you may recall, this investment was made initially back in 2007, December of 2007. The plan committed $40 million to the fund. You've subsequently reinvested approximately $22 million of capital since that time. And the returns have been as follows. On the 1-year basis, about 7.4, over 3 years, 5.4, 5 years, 6.7, 10 years, 10.2, and a 6.6% since inception. So what we were going to do this morning is dig down a little deeper into what's going on with the portfolio at present and what our outlook is and strategy for the continued outperformance of this vehicle. You will hear me reference throughout my comments the term ODCE, ODCE. That stands for the Index of Private Core Real Estate Funds, and that's the benchmark upon which we base our performance in this business. Just some quick updates. We're actually holding our advisory board meeting with several of the large prime property fund investors in New York as we speak. That's going on this morning. In the first half of this year, we generated returns of 5.5%. This performance over that 6 months is approximately 57 basis points below the ODCE index, which is something we have not said recently, but over 1 year, we have about 66 basis points of outperformance, and we'll show you the relative outperformance in a few slides, but that has been over 10 years around 188 basis points. So we believe that we have the ability to continue to outperform on that basis. I will tell you, as it relates to what's going on in the world today, in the first half, you've probably heard this before, but we saw a rapid increase in fundamentals in the first half of this year. We talk a lot about net operating income, and the portfolio was up in the first half of this year about 13.7 year over year. In terms of NOI growth, now that's obviously compared to a lower base from 2020. Nonetheless, believe it's a great representation of the growth that we have seen in the reopening. Obviously, there's some new considerations in the world with the Delta variant, the Mu variant, and these are things that we are prepared to address. So I'm going to skip ahead in the interest of time to the Section 2, which gets specifically into the Prime Property Fund. What I will tell you in a question you wanted addressed organizationally, we have had no changes. I am sad for those of you who knew Kent Goodwin, who was an independent director of the fund. Kent passed away suddenly and unexpectedly in October of 2020. We have gone through a very significant process and recently announced the appointment of John Rice, who's going to be joining our independent advisory committee. And we'll be happy, that announcement's being made today, and be happy to follow up with additional information on John's background and skill set. Otherwise, portfolio management team, asset managers, acquisitions remain very much intact, and we believe continue to provide a real advantage in the continuity that we've had with this team. I'm going back and forth between glasses on, glasses off, because they keep fogging up on me. If you turn to slide 13, this is just for everyone, so we can all start on a level base. Again, this is a core real estate fund holding that's diversified by sectors and geographies across the United States. The fund is over 40 years old in terms of term, and it's diversified, so we'll be talking about sectors like residential, industrial, office, retail, and some emerging asset classes where we have a fairly meaningful position, like healthcare, life science, self-storage, and others. And our goal over time is to generate, our target is an 8 to 10% return over long market cycles. Again, you heard some of the figures earlier. You've had an interesting 14 years to go through a pandemic and a global financial crisis and everything we've experienced, and have maintained that position, and it's grown over time. That's our objective, and we are also targeting roughly half of that, or around 4 to 5% of that, in the form of current income, which, as you know, you have reinvested some of those proceeds. On slide 14, some key metrics on where we stand today. The fund on a gross basis, that's with including leverage, which we'll talk about, is around just over $35 billion. The net asset value or equity of about $28 billion, that makes this fund one of, not the, but probably one of the top 3 largest vehicles in the Odyssey Index, and we think that scale is a competitive advantage. But with that said, we're also one of the lowest levered. So you'll see the leverage of just under 18%. If you look at the Odyssey Index, which I mentioned earlier, that number is probably closer to 23 to 24%. And our view is, with market uncertainty and our ability to grow NOI the way that we have, there's no need to take on additional risk in the portfolio. So that's a very defensive position, and it could, in fact, be listed as one of the reasons why we continue to see very significant net inflows of capital into this vehicle, perhaps more so than the rest of the index. Please.
Talk about philosophy around leverage a little bit more than that, because it has moved around over time.
Yeah, no, that's a great point. For any committee members who were here when you made that decision in 2007, and I don't know if that's the case or not, but at that time, leverage was meaningfully higher, both in terms of the Prime Property Fund and in terms of the Odyssey Index more broadly. As we went through the financial crisis, I think everyone began to re-examine the way they thought about leverage and its cost-benefit analysis. The Odyssey Index will permit or allows for leverage of up to 40%. I'd say 15 years ago, we probably were managing this somewhere between 25 to 35%. And our experience coming through the global financial crisis was that we've put a huge premium on being defensive, being lowly levered, having a strong balance sheet, and that's allowed us to weather certain circumstances like what we've experienced here of late with the pandemic. And that's something we intend to continue to do. We used to have a target of around 20 to 25%, and we've actually, in the vein of that defensive posture, we've actually gone to our board and we've approved lowering that target to 15 to 20%. So we intend to continue managing the vehicle within that range. We talked about, when we say core, that can mean different things to different people. When we say core, we mean high quality, well-located, well-leased, cash-flowing assets. There are a lot of new sub-strategies that have been growing, core plus, value add, all these different buckets. We are focused very much on our mandate to manage core real estate. And today that sits at 94% leased, and that's actually up several hundred basis points from where we were last year. And I'll show you some of that leasing information, and I think that's relevant just as we talk about the reopening and the recovery and what impacts that's had on your portfolio. Yes?
What about delinquencies? People late paying?
Yeah, we certainly have dealt with that, with the exception maybe of industrial, almost universally across the portfolio. We have probably seen that's been most significant in retail. We will talk about that. This fund is a net underweight to retail relative to the Odyssey Index. So we agree thematically with the headlines about changes in consumer behavior and what that means. With that said, and I think ACG probably has spent some time with you on this, the retail that we own is what we would call irreplaceable fortress malls. These are not assets that typically trade in the private markets, but rather are controlled by publicly traded REITs, and it includes the likes of Fashion Valley Mall in San Diego, Dadeland Mall in Florida, and those would be considered by Green Street advisors, arguably, two of the top, maybe even 10 to 15 malls in the United States in terms of productivity and sales on a square foot basis. And those numbers today, even through the pandemic, have been around 1,100 to 1,200 per square foot. By comparison, if we were to pick a lower quality or B type retail asset, those numbers may be more like 300 to 400. So just to give you some perspective, what we've done with those tenants where necessary is we've done a rental deferral. And I would say that our collections on those deferred rents have, again, when I talk about NOI growth, a lot of that reflects that we're now realizing some of those deferred payments. But that's not to suggest by any means that that program is over. Rather that we're just working with our tenants and trying to be as reasonable as possible, but practical. There was those situations did occur, and they would also be situations where we would talk about potential leasing opportunities in other spaces that we had around the country, but those would be more on a case-by-case basis than a blanket policy that we would have as we were engaging in those conversations. But we have a great, perhaps everyone says that we have a great tenant mix. We feel like we have a great relationship. We work with tremendous operators, including groups like Simon as joint venture partners, and we continue to be confident in our retail, especially on a relative basis to other B and C type product, which we believe will become obsolete as this transformation in consumer behavior continues, all to the benefit of really the industrial, last mile warehousing, et cetera. And that's where the overweight that we've had in industrial, the $9 billion of assets that we own in that space, has really been a driver or one of the drivers to your performance. I talked about performance on the bottom of 14. I won't have to read this to you, but the prime property fund is in the blue bar. The index is the gold bar, and you can see those different time periods and what the relative performance has been relative to the benchmark. So jumping ahead for a moment, I think 17 is a helpful slide. This breaks down for you the size of our positions in each one of these sectors. So going from left to right, this breaks down for you office, apartment, industrial, retail, healthcare, and self-storage. I'll tell you office, again, is an underweight relative to the Odyssey Index, as is retail. Industrial has been an overweight. Apartments, I'd like to spend a moment there because that's been a tremendous performer for your portfolio during the time that you've been invested. And the real driver for that is we've approached apartments and multifamily very differently from the market. And that is in 2006, for those of you who were involved, you may recall, we took private a publicly traded real estate REIT called Amley Residential. They traded under the ticker AMLI, looked and felt likely very similar to what you would see today with Avalon Bay Communities, AVB. And when we did that, we internalized the management team, and we made them a captive operator for all of our multifamily that we would be doing in the U.S., and that included selectively some development value add style investing in this fund. Multifamily has been the most significant outperformer relative to its peers across these sectors. We attribute that obviously to an extremely high quality management team, and that we're operating everything under the Amley brand. And that branding has real benefits. And I'd say they have exceeded all expectations from our team during and especially over the past 18 months, and continue to operate at a very high level. And I think the other thing that's notable and should be on the record for you is that you also benefit from what we're doing with Amley, because from time to time they will have projects, especially in the development space, where we will not feel comfortable providing all of that equity as we look across the portfolio, and they'll bring in a Canada Pension Plan or the Virginia Retirement System or large institutional investors who are paying fees to Amley. All of those fees go to the benefit of our investors, and that's been another really strong contributor to your outperformance. I mentioned the niche sectors. This is probably the biggest theme that's going on right now in our space. Many of the core managers are trying to diversify into newer sectors. I remember 15 years ago having, arguments about does healthcare, self-storage, does this stuff belong in a core portfolio? And it was a real active debate. I think today the world is really moving that direction. So as I said at the beginning, we've really benefited from having 10% of our portfolio in those sectors. That's going to be a very popular place for capital going forward. And our ability to source and continue to add positions will really depend on what the capital markets allow. But we certainly would rather be holding these positions than trying to establish them new in sectors like life science. For example, the self-storage space has been it's not something where you would have any impact going off and buying one-off assets or little portfolios. But again, we acquired a multi-billion-dollar portfolio. We've sold out of certain markets that aren't strategic, but it's been a very good net operating income contributor on a year-over-year basis consistently. Sure. So the healthcare probably breaks down into what we would call MOB, medical office buildings, as well as selectively life science. Life science is really where you're fitting out office-type space, but very specifically for biotechnology and other end users who need very specific spaces, lab spaces, et cetera, for their business. And they tend to be what we would say stickier tenants, because when you build out that space, it's for their specific end uses. These sectors have been very resilient during the downturn. These businesses are obviously essential businesses, therefore they've remained open, and demand, of course, continues to be very strong. And that is really today, a lot of that activity is up in the northeastern United States. Boston accounts for a significant amount of that. However, we do expect that demand for this type of product and opportunities in this product set will continue to proliferate in certain markets, not all, around the country. I think the most important page in the book is probably page 20. And this is the term I've used for the last 10 minutes around what we call NOI, net operating income growth. If you look at what's going on in the world tonight, if you look at what's going on in the world right now, there's a very heavy weight of capital looking for real assets. They're looking for yield. Everyone here knows what's going on in the treasury market. Traditional fixed income has been a very difficult place to find that yield. Real assets, I'll use a broader term that includes infrastructure and real estate, but real assets has probably seen a disproportionate of capital that's been rotating away from that fixed income looking for these yields. We expect that will continue, but what that means is that to generate returns, you're not going to do it through appreciation necessarily. We've come through, and you've been part of, we've really ridden this appreciation wave, especially coming out of the global financial crisis to the beginning of the pandemic. So where we've really looked to generate our returns is that we own assets where we are able, through active asset management, to increase rents, raise occupancy, reduce expenses, and therefore expand the net operating income that we're generating. And so when we talk about the outperformance, I think it's interesting, and this directly impacts you because it's really during the time that you've been an investor with us, but we've generated, if you look at the first bullet point on the left, over 5 and 10 years, our NOI growth on a same-store basis has been double of what the NOI growth has been in the Odyssey Index. As I mentioned at the beginning, it's been especially strong in the first 6 months of this year, driven by the reopening. And so when we think about how we're going to generate that 8 to 10% target return over long market cycles, I hope it's in some way reassuring that we're not of the view that we're going to generate that through market appreciation, even though given the weight of capital coming in, that could certainly happen. But rather, our focus is on really working with the assets that we own in the portfolio to grow that NOI. And we continue to feel that the assets that we own today are capable of that type of growth. Otherwise, when you think about what we're selling in the market, and I'd certainly say we've been surprised to the upside in the first half of the year when we are disposing of assets. At the moment, they are trading or selling at a fairly significant premium to where we were holding them. But those assets where we feel that we can continue to drive that NOI growth is an important characteristic, and hopefully we've demonstrated to you, and we've got some numbers here at the bottom about where we are in the first half of 2021. Now that is compared to 2020, maybe not a fair comparison, but certainly again gives you a sense for what's actually happening in your portfolio. 21 is just, this is a helpful, I mean, I mentioned this, but you can get a general sense here. On the left side is the allocations, the asset allocations for the Prime Property Fund. On the right side is the Odyssey Index. And that's where you can look across and see where is the prime property fund relative to the index and see office underweight, retail underweight. Apartments, again, which has been such a great contributor, that's about equal weight. We'd love to make that higher. But remember, we have a 10% right now exposure to these niche asset classes. But we'd certainly like to do more in the residential space with AMLI as possible. I think everyone has questions around office. We continue to believe, number one, it's good to be in this situation because it has been 12 months of a lot of zooming, but we do believe that in major markets for A-class, well-located assets, there will continue to be demand for that space. You're looking at de-densification versus work from home and remoting, and there's of course going to be some offset there, but the bigger picture would be on page 24. You can see recent tenants that we've signed: CNA Financial, Deloitte, Ernst & Young, Facebook, Google just re-upped in our San Francisco Hills Plaza asset. You can see on the bottom right of page 23. SEC, Skadden Arps, the law firm, so very high quality, reputable, dependable, longer-term tenants. But I would say we're disappointed. If we had to chalk up wins and or surprises and disappointments for the first half of the year, the reopening in major cities here in the U.S. has gone slower, especially in San Francisco and Washington, than we may have planned for, or that you even see on a relative basis. With that said, we're not giving up on Washington, D.C. Or these major markets. They'll continue to play, we believe, important roles in the ecosystem with office, and we continue to believe that over longer periods of time, those will be more liquid markets. And you may argue with that. Some may say it's moving to Nashville and Charlotte. There are certainly opportunities there, but longer term, again, we've been doing this for 40 years. We think liquidity ultimately resides with the larger, well-located major markets in the United States, especially when you consider foreign capital, which has grown substantially in terms of the buyer pool that we're dealing with in our portfolio. How am I on time? Wrap it up, okay. Maybe I'll wrap it up by turning to the back here. I'd say on page 47, if you can get there. One point I didn't emphasize enough, this is this is Morgan Stanley's only vehicle for core real estate investing. We don't have a core plus fund. We don't have a vehicle where we raise high net worth or individual capital for investment. So all the opportunities that are sourced go to this vehicle. You saw the team pages earlier, tremendous focus on the management of the fund. I think the consistency and approach is very much there. Now, there are, of course, exceptions to that, like the delevering, which we discussed earlier, have continued to provide fairly significant outperformance for your plan relative to your benchmark. And we do think at the end of the day, it's an irreplaceable portfolio that we've assembled, and would be happy to take additional questions.
On slide 20, where we're seeing the net operating income.
Yep, yes, sir.
We look over at 2020, I would assume that's because of COVID, but I would just like to hear it from you. Is that downtick there in the 2020 results primarily for that, or is there other things for that? And what do you feel like the firm needs to do, such as wait it out, or if there's other actions that you feel like the strategies need to be to turn that back around?
Yeah, well, thanks for the question, Marty. I mean, 2020 absolutely is impacted by the pandemic, and I can't stress that enough, and that's why I don't even like saying, that we're up 13.5%, because you're comparing that, obviously, to right in the teeth of the pandemic. And just, there's a line here that says other, just so we all are on the same page. The other is, we own one hotel in this portfolio. We don't think hotels belong in core funds, but we did have an opportunity to buy the Boston Harbor Hotel. If you're familiar with that hotel, which is adjacent to some office space that we own there, so has some real strategic benefits. That was off significantly because they've been closed on and off due to the pandemic, and obviously revenue per room has been down. But I think that our belief is that the 2021 figures, right now, we're back to, I'd say importantly, we're back to 2019 levels in terms of where NOI is in the portfolio. The reopening, again, the first 6 months of this year has been extremely robust. We don't have a perfect answer for is what, may or could happen as it relates to new developments with the pandemic. With that said, I think over the last year, we've been working extremely closely with every single one of our operators, every one of our asset managers, our assets. We know exactly what and how to hopefully operate these assets safely, but also efficiently. I don't know if that answers your question, but
Well, I think it does. I suspected it was because of the pandemic.
Yes.
Was the primary driver on that, and a lot of that, so much of that is out of our control, especially when the government shuts things down. What else can you do?
yeah, but now that, I agree with you, but now that we've had a year of understanding certain steps that we might take, and whether that's Emily coming to us saying, look, these are things we want to do in our or need to do in our apartments going forward, whether it's distancing or how the elevators work, same with many of these assets. So our hope is that, maybe you read the same thing. I saw something yesterday saying the World Health Organization was suggesting maybe that this, virus is with us in some form forever. So I think, we're all going to be in a situation where we're adapting and relearning how to best configure space. And so I'm not suggesting we can beat the virus, but I certainly think we've learned over the last year a lot about how to run these assets most efficiently, irrespective of what the status of the virus is at the moment.
Thank you.
Any other questions? Well, thank you very much. It was a really good presentation.
Okay, well, thank you for your support, and we're, of course, here if you'd like to ask any further questions.
Thank you.
Thank you.
Item number 3 on our agenda this morning is to approve the minutes of the meeting of August 16th. Chair will entertain a motion. Have a motion and a second. Please record your vote. That item passes. Item number 4 is the consent docket. We have one item. Have a motion and a second. Please record your vote. Item passes. Item number 5 is to ratify approvals. Have a motion and a second. Please record your vote. Item is approved. Okay, as I get down here, for some reason my screen is not scrolling. Oh. Just a little help from my friends here. Item number 6 is to approve the claims docket. Have a motion and a second. Please record your vote. Item is approved. Item number 7 is to approve the following applications for service retirement. Have a motion and a second. Please record your vote. Item is approved. Item number 8 is to receive the report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. Have a motion and a second. Please record your vote. Item is approved. Item number 9, receive report of death, authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Item is approved. Item number 10 is to approve continuation of pension to spouse. Have a motion and a second. Please record your vote. Item is approved. Item number 11 is to approve the request of the following to terminate vested rights and commence retirement benefits. I have a motion and a second. Please record your vote. Item is approved. Item number 12 is items for individual consideration. We have one item this morning. It's approved the Northern Trust fee schedule for our custodian bank and benefit payment services with the addition of the benefit payment web participant services feature. Does anyone have any questions on this item? Hearing none, the chair will entertain a motion. I have a motion and a second. Please record your vote. Item is approved. Item number 13 is to receive the investment consultant report.
Okay, good morning.
Good morning again.
You should all have the August flash report in front of you. Just a few comments on the capital markets, and I'll tie that to the comments from Claiborne with Morgan Stanley. You know, we saw another positive month in August. So as we look at your trailing results for year-to-date, 1, 3, 5, 10 years, very strong returns. Year-to-date, a little bit behind the benchmark. That's primarily due to a couple of things, a little bit more defensive in small cap, and I think we've talked about this a little bit. It's been challenging for active small cap managers to keep up with the benchmark, particularly the lower quality names in the small cap benchmark that have just gone up exponentially. Think of like GameStop, AMC, and things like that, where they're in the benchmark, that's pushing the benchmark up, but fundamentally they're just not sound businesses, so your managers don't own them. And then your long short equity allocation, it's an insurance portfolio, if you will, designed to provide protection. It's up about 17% on a trailing one-year basis. Year-to-date, it's up about 2.7%, so just much more conservative. But just as I stand here and I look around and I see us wearing masks again, and just thinking about how much has changed from month to month, not just from March of 2020 to September of 2021, but within that time. And that's really We've come a long way with really strong markets since March of 2020 and really since 2010. And we know equity markets don't just go one way. There are downturns. And so having a little bit of insurance in the portfolio that's been a bit of a headwind recently, I think is appropriate. And we're continuing to manage the assets that way. As you look at the first, on page 1, you do continue to have a pretty significant overweight in equities, just because equities have outperformed every other asset class by so much. We have been trimming that monthly and quarterly to pay benefits. We're actually in the process of a pretty large rebalance right now, where we're raising 22 million from your equity managers to cover operating expenses for the balance of the year. Hopefully, it may not. If we need to raise a little bit more, we can. And then also the funding of Morgan Stanley, which we believe that 14 million additional subscription will be called sometime in the next month or so. That money is being raised, 11 million from large cap, Intech, your benchmark risk controlled manager, and then 11 million from small cap, and that's split 7 million from Earnest Partners and 4 million from Times Square. 7.5 million from Earnest and 3.5 million from Times Square. So we'll be bringing both large and small cap down. In addition to that, just as a reminder, the biggest underweight on this August report is real estate overall, 5.5%. And within real estate, it's that opportunistic real estate piece. You did make a commitment to the Starwood Distressed Property Fund of $15 million in 2020. They haven't called any of your capital yet. That fund, their fundraising period has remained open, and their final close is this month. They've been using a credit facility to invest in properties since the fund was open, so they haven't called capital from investors. But with that credit facility, they've invested about 20% of the capital of the overall fund. Once they have their final close, they expect to start calling capital down to pay down that credit facility. So it's our expectation that about 10%, or $1.5 million a quarter, of your $15 million commitment will begin to be called most likely next quarter, if not first quarter of calendar year 22. So while you see this big underweight in real estate, we have done some things to move that the other direction, and that's in process. Just turning to the next page and looking at results, as I mentioned, August, another positive month. We've seen September, the first few days of the month, we have seen a little bit of weakness and sell-off, which is really to be expected. But year to date, you're up gross of fees 9.3%. The benchmark's up about 11%. Really the biggest areas, it's as I mentioned, small cap and long short equity. International, everything's slightly behind. Emerging markets are ahead by about 3%, really driven by Wasatch. The Wells Berkeley Street strategy, July was a tough month for emerging markets as there was volatility created by new policies in China that really affected a number of industries in China. The emerging market benchmark is about 40% China, so that has some impact. The inclusion of Wasatch as a emerging market small cap manager has really provided some actually protection while the broader market has gone down, because small cap hasn't gone down as much, and the Wasatch strategy really doesn't have a significant allocation to China. They're much more overweight to India, and so that's really offset some of the challenges we saw in the month of July. Looking at the one-year numbers, however, it's still very strong. The fund is up 21.2% on a net of fee basis, about 1.5% ahead of your policy index over that period of time. More importantly, significantly ahead of your 7.1% target rate of return. As you know, you all have been very diligent in being thoughtful about forward-looking expectations. I was at a meeting last week where a trustee said, well, why are we talking about lowering our assumed rate of return when if we look, you know, we've got 8.5%, 10% the last 10 years? I'm like, the standard line you hear from investment disclosures is past performance is not indicative of future results. I think as we've talked about, the starting point where we are today, very low yields in the bond market, very high valuations in equity markets. As a long-term investor looking out over the next 5 to 10 years, it's going to be very difficult to get these types of returns. Even though we've seen them, it seems like never ending for the last 10 years. But it's if we think back 2018, and I remember, Paul, you asked me the question, what happened at the end of 2019? Why do our 2-year numbers not look better? And it's 2018, we were down about 3%. So it doesn't take too many months to have that. But overall, the long-term results continue to be very good. Just finishing up and just some final comments on real estate. I know we talked about we're adding money there. Just as a reminder, why do we have a 15% target to real estate in the portfolio? It's designed to do a few things. One, get a premium return to bonds, and the core real estate that Morgan Stanley is managing, our expectation is that 80 to 90% of the return from that really is coming from the operating income, not price appreciation over time. There's going to be short periods of time where you do get big bumps in price appreciation, but it's really from that income component. And that offsets equity market volatility. So it's a premium return to bonds with less volatility than equities, so a good diversifier. The other advantage of real estate in a portfolio, or other component of real estate in a long-term portfolio, is as a hedge against inflation. In a rising inflationary environment, the ability to raise rents on properties is a hedge against inflation. So it's an inflationary hedge within the portfolio. We're very pleased with the performance of that. You know, certainly when we look at it compared to equities, you're up 40% in equities. Your real assets are up a little under 8% for the year. That's really where we would expect it to be. And probably in a year like 2021, it's a little bit higher than we expected coming into this year. So certainly very pleased with that. Next month, we have invited, just continuing to have some managers in just to hear and get some reviews. We have invited your emerging markets managers in. Wasatch and Berkeley Street will both be here next month. So no manager issues or concerns at this time.
Okay. Anyone have any questions for Jason this morning? Okay.
All right, thank you.
Thank you, sir. Chair will entertain a motion to receive Jason's report. Have a motion and a second. Please record your vote.
Trustee Culver, how do you wish to vote? Thank you.
Item is approved. Item number 14 is comments from board, staff, and citizens. Looking forward to seeing those of us that are planning on heading to Shangri-La at the end of the month. I anticipate another excellent conference. They're always really good. So, the firefighters are sponsoring it, yeah. A golf tournament Wednesday morning, and then things get going Wednesday afternoon, Thursday, and half day Friday. So, look forward to seeing everybody that's going to attend up there, and everybody else, we'll see you next month.
Chairman,
Yes, sir.
There, I think my mic is on now. I just had a couple of comments I'd like to give out. One is, really appreciate these speakers that you're lining up for us, that are coming in and giving us reports and informing. I feel like it adds something very nicely to the meetings, and, you know, I think it's good for us to hear from these managers and see what they're doing. The other thing is I'd just maybe like to take a second to be a little bit of a cheerleader and just express how enjoyable it is when we're approving people's retirements. And it kind of struck me this month, there's a couple of people in there, an airports director and accounts payable staff member who I have known and worked with. And it's just so rewarding in this position to see that people fulfilling their careers, and that not only are they fulfilling their careers and taking that next chapter in life, but knowing that their funds are there and safe and ready for them because of the work on this board and the many people here that help support that. So that's my little cheerleader moment. I just wanted to say that and just express, you know, how enjoyable that is as a member here on the board. That's all I have.
Okay. Hearing no other questions or comments, we are